Hello traders, this video is recorded by Georges Beaulieu, the founder of stochastic.macd.com. The title of this video is The Conspiracy of a High Frequency Trading, or the Conspiracy of HFT. In this video, we're going to discuss some conspiracy theory concerning the high-frequency trading, because a lot of traders are asking a lot of questions. Okay, what's going on? Is the market being rigged? All right, is the market being manipulated by these high-frequency traders? It is people dangerous traders, and we want to discuss the conspiracy of high-frequency trading. I encourage traders to watch the full length of this video so they may understand exactly what's happening. All right. If you are a computer geek, you will read a Computer Geek magazine. You will go to Computer Geek conference. You will watch Computer Geek videos to understand what's happening. All right. In your a sector. All right. In your interest, very important. The same thing as a trader, we want to understand the implication of high-frequency trading, whether we should ban them, all right, whether we should stop them, whether we should fight them, or whether we should trade together with these high-frequency traders. Are they friends? Are they foes? All right. So this is what we're going to discuss here. In 2008, ladies and gentlemen, something very, very important has happened. We had what we call the financial crisis, and the market went down. Now, talking about this bearish period, this is exceptional. A lot of hedge funds has to close their business. A lot of business went bankrupted, all right? And even some big names, Lehman Brothers, went out of business. It's one of the worst financial crisis that the world have ever experienced. Not only that, no one was expecting it. Many market participants, even the biggest market participants, were not expecting, okay, the bearish cycle of 2008. Because of that, okay, different strategy has been put into place, all right, to avoid that no one, okay, get caught up again with this kind of a bearish cycle. Even government decided to ban short selling because they believe that these are the short sellers were the reason or the cause of the 2008 bearish cycle. But I can tell you now, the bearish traders were not the cause of 2008 cycle. Now, in fact, I am the creator of TSCWSY08, and the 8 represents a cycle. All right, 8 represents a cycle. So now, because for us that understand the Elliott wave, we have 1, 2, 3, 4, 5 wave, the multi wave, plus 1, 2, 3, corrective wave, 5 plus 3, that's 8. So when we are talking about 8, we are talking about a cycle, a full cycle. Now, in 2008, many big institutions were not prepared, were not expecting the bearish season. As I will show you now on this chart, you may wonder, John, what that's got to do with high-frequency trading? That's why I say to you that I recommend that you watch the full length for this video to understand exactly what is happening. All right? Especially if you are a day trader wondering why the strategy that you were using before, and now the music has changed. All right? So different strategies were put in place, and one of them is the high-frequency trading. So the idea behind the high-frequency trading is that we don't want to stay in the market too long. All right? We want to take small profit consistently and fast. So if there's going to be a bearish cycle, okay, we will be out of the market before everybody else, and we will not take any big profits, and we will not go bankrupt. This is one of the reasons for the high frequency trading. A different, okay, trading tool were created, okay, to control, okay, this bearish cycle. So the idea behind the high frequency trading, as I explained to traders before, is that we want to be the first to know. So we want to know first before everybody else. So if we know that the market is going to go up, if the market is about to go up, we want to be the first person to know that the market is going to go up. We want to be also the first person to place the trade before everybody else. And if we're going to take profit, we want to be the first person to take profit before everybody else. If the market is going to go down or crash, we want to be the first person to know, and we want to be the first person to be out of the market before everybody else. So now you understand, there's nothing wrong with this strategy of high frequency trading. It's just people are worried about, okay, a bearish cycle. So government, so lobbies consulted the government saying, ban the short sellers. They are the one destroying the value of investor. They are the cause of the bearish cycle. Once we ban the short sellers, all right, and we bring in now computers, we remove human beings from the market, we will never have this sort of a bearish cycle ever again. Now, I can tell you now that the market will go up, the market will go down, there will be market crash if we have accumulation or distortion over the year. We cannot stop the winter. You will have the summer, you will have the spring season, you will have the autumn, and you will have also the winter. By the way, most experienced traders or market participants and investors are aware of it. They trade cycles. All right? But in 2008, if you look at this stock here, this is Johnson & Johnson. All right? We are on the quarterly chart. You may say to me, George, what has got to do with high frequency trading? Stay with us. Where are we? In 2008, in fact, in 2007, I was here, and in fact, I was testing a lot of trading strategy, and I was telling my woman that time that the market is about to go down, all right? And I have one special free demo account that I was using that time, and I was telling her that the market is going to go down in 2007. But I said to her that because the market is going to go down, a lot of big market participants will be fighting the bearish move. You can see it's 2007, this is Johnson & Johnson, a very bullish stock. That's why I'm showing you now. Now, because Johnson & Johnson paid an excellent dividend, all right, so investors buy and hold these stocks. We know that. So people were buying Johnson & Johnson. But we have to understand that there are different types of market participants. Technically speaking, a lot of smart technical traders recognize that the market is due to go down. And you can see sometimes there was some discussion on YouTube, on the web, and no one was paying attention because at that point in time, the fundamentals were very strong. So across the board, the rating was positive. Buy. But technically speaking, there was a warning coming out telling us that there's a high chance that the market may go down. That's why I say to traders, combine the technical and the fundamental. Don't call it technical trading mambo jumbo. Don't call fundamental trading mambo jumbo. Don't call high frequency trading crazy traders. All right? Pay attention. So, but in 2007, the market, as you can see, the market was going up. Because, you know, it's like if it's going to rain, you don't just suddenly the rain doesn't come boom down, okay? So you start getting cool, and then the cloud gathering, and then different stages go through, and then suddenly, pooh, it's the rain. Same thing for the storm. You don't just come, it just boom straight away. All right, so they have some indication, like in London recently, we have some high-speed winds. So this warning was there. The meteor, the weathermen were telling us. So there are some indication in place. But now, do you acknowledge them? So the market went up. Because the technical traders, the smart technical traders, knew that the market is due to go down. They were watching. In fact, the short sellers were busy selling. All right, they were distributing. They were not accumulating. Because they were still in the market, they were not banned. They didn't buy the short seller that time. They knew that, okay, the market is going to go down, so they were just selling. As the either fundamental trader were buying, because when they check all the ratios, everything was great. You can't sell this stock. It's bullish. It's bullish. So one group knew that it's going to go down, another group believed that it's going to go up, and the price was going up. In 2008, if I move my vertical line, this is about the conspiracy of high-frequency trading, why we have the high-frequency trading, what strategy they are using, and what's going on. In 2008, suddenly, we start seeing the news. The news start coming out about, the big companies start going down, the banks, the rumors start coming out that the banks were under pressure, that the mortgage market, the property market is going to collapse, and now everybody start believing what the technical trader was saying long time, that the market is due for correction, a big correction. Well, you understand? And finally, everybody knew that, okay, now it's too much. Everybody was pulling their money. And can you believe it? Even Johnson Johnson, one of the bullish cow on the Dow 30, went down big time. This is a serious matter. You may say to me, George, that's Johnson Johnson. I will show you another financial instrument, Intel. And I'm going to put on this chart again another vertical line. This is about the conspiracy of high-frequency trading. Why do we have a high-frequency trading? Why are they using algorithms? Why we have more computers trading than human beings? Why the market is now almost unidirectional? Why is it going only in one direction? What's going on? What's the future of the market? Are we going to have another market crash in the future? I can tell you, yes, we will have it. You'll never have a market that's going up forever. Now, but the idea behind, I can tell you this now, the idea behind the high-frequency trading, this is about a conspiracy, remember it's a conspiracy theory, is to stop the market going down. This is one of the conspiracy theory about the high-frequency trading, that the market does not go down anymore. Remove the human being, remove them with computers, have programs that we can control, so we can, all right, control it. So with algorithms, so if we are controlling with algorithms, it will not go down. So if you have a powerful algorithm that can push the price up, that no one, human being, cannot push it down, well, he will not go down. But I'm telling you, the price will go up, will go down, all the time. Go and read history, all right? If you're trading, read a bit about the history of the stock market. And so the idea, the conspiracy about the high-frequency trading is that we have a market that is going up non-stop all the time. It's great that the market is going up. If it's displaying high, lows are high, don't fight it, all right? Okay? It's great for the market to go up. It's good for the GDP. It's good for the investors. It's good for everybody. I'm not a bearish trader. I'm a bullish and bearish trader. I don't, all right? If you allow me to use this word, I don't give a damn, all right, whether it's bullish or bearish. If it's bearish, I'll sell. If it's bullish, I'll buy. Okay? But there is another group of traders that are always bullish. They never sell. They buy all the time. They will even buy here. All right? They just buy. We want to buy. We want to buy. What's going on? The market went down today. This week the market went down. But the market was going down for 5 months. But the market went up 1 week. And the news there will come out, it's like it's Armageddon. Everybody say, wow, the market went down the whole week. So the idea, the conspiracy about the high frequency trade is to have a market that is always bullish, that we can control, that does not create any surprise for us, that's like in 2008, and business going out of business, and we have a bearish stock market. Okay? We want to have the government to ban the short sellers, in fact to ban selling altogether, and we want to have big market players in place that are monitoring any selling activity and any sell orders must be busted, okay? And this is about the this is the conspiracy of high frequency. So you can see in town, if I draw my vertical line again, in 2007 we were here. That's the vertical line. So in 2007 the price was going up, but the technical trader knew that the market is due for correction. But the market did not go down straight away. But in 2008, right here, as the news started coming out, because most of the big market, the big institutions are fundamental traders. So now the fundamentals now, the news are coming out, whoa, warning, bearish warning by this company, bearish warning by this company. Now, people couldn't pay their mortgage on time. Banks start taking houses and all these things coming out, and the bank do not have enough money to remain in business. Now government has to support the banks, and the money printing has started, blah, 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 blah. Now the fundamental traders said, now we have to sell. And the market was going down, okay. In 2008, as you can see, it went down up to 2009. From 2009, we start seeing another type of algorithm traders, the high frequency traders. Now, you have to understand that throughout the history of almost from year 2000, we always have algorithm in the market. There were algorithms that were swing trading, algorithm on the weekly chart, monthly chart, quarterly chart, daily chart, hourly chart. They always use algorithms, but human beings were trading mostly. But now, from 2009, we have what we call a plethora, okay, a huge increase in the number of high-frequency trading firms. Because everybody say now, I don't want to remain in the market for 2 days or 3 days. I don't want to put my money on the table, because in the past, the big institutions were placing a trade and holding a trade for days, for weeks, for months, for years. All right? And ordinary traders were busy trading on the 5-minute, 3-minute, taking a 30 pips here. And that's the way it was. But in 2009, the game has changed. The big market players put a huge amount of their money onto the lower time frame, even on a 10-second time frame. The idea behind it, be the first into the trade, be the first out, be the first to know, all right? And we have seen it. In 2010, we have what we call the flash crash. What has happened, as you can watch video on YouTube, is that no one can confirm it, but this is about the conspiracy of high-frequency trading. The high-frequency trader pulled out of the market, and there was no liquidity. The market crashed. So, which means they knew that the market is about to go down at that point in time, and everybody come out at the same time, and the market crashed. So, be the first to know, be the first out. Everybody knew, everybody was the first out, the market crashed. So the market crashed, everybody said, what's going on? Within an hour, the market recovered again. The computers bought it again. So the big idea about the big conspiracy about the high frequency trading is to keep the market going up. So how do we do that? How can a high frequency trading firm keep the market up? That will be a discussion. That will be okay, the subject of another video, and I will demonstrate to traders how one can use okay, a high frequency trading algorithm to control the market. If one wants the market to go up, one can disable all the sell signal. So if you tell all your algorithm, okay, disavow or do not take any sell signal, the computers will not take it. And as the price, the computer will only focus, which means priority, to buy signal only. They'll keep buying, keep buying. If you are a dominant force in the market, you can propel a stock that is normally due, technically speaking, or whichever way, fundamentally speaking, due to go down, you can propel it up and keep the market up. But do we have to ban, okay, the high frequency traders? No. People say to me, John, you are crazy. Are you receiving some money from high frequency traders? No. Do you have, okay, do you have any interest in high frequency trading? Yes. Why? Well, my interest is that when they are buying, I want to buy with them. If when they are selling, they are selling. That's the interest. So I want to know how they are trading, so I can trade together with them. All right, if they are the winning side, of course. So we can see for Intel the same thing. I will bring on now another financial instrument, and I want to show you now again. This is Boeing. And again, I will draw on my chart a vertical line to highlight the 2007. So somebody somewhere thought that, okay, we had enough of the bear, we have enough of the ups and downs in this market, and we cannot take this anymore. And we must have a market that is controlled, a market that is disciplined, and that we can control with the computers. We can create a technology that can control the markets. So first thing we need to do, after the 2008, this big surprise, how come, all right, the bear can short the market? They were shorting, we didn't know. Now we can have a software that are scrolling the Twitter feeds, the Facebook tweets, and the Google Plus posts to know whether traders, human beings, are thinking to sell. If we see that the majority want to sell, we will not allow that, because we are bull, we are permanent bull, we are eternal bull, we don't want the market to go down. Well, in fact, if we see that they want to sell a big market, they want to sell a market leader, we will stop them, and we will keep the market up. Now we will no more allow these people to mess at the market. The first thing is to bring in regulation to ban the bear. Once we have few people short in the market will never go down again. So this is the conspiracy of high frequency trading. And also, to avoid that, if the market is going to go down, it will start going down fast from the lower time frame. You understand? So if it couldn't go down on the 1 minute chart, it's not going to go down on the hourly chart. If it couldn't go down the 10-second time frame, it couldn't go down on the 1 minute chart. If it couldn't go down on the 1 minute chart, it will not go down on the 2 minute chart. So what we need to do, ladies and gentlemen, is to go to the lower time frame and make sure and monitor every activity. In fact, strategically speaking, it's smart. But there is something else that is taking place. By trading on the lower time frame too much without any consideration to the market principle, one is creating distortion. That's why I'm recording this video. My concern for the future of the market is the accumulation of a distortion. There's another type of distortion that I talk about, is the distortion of the time. You can distort a financial instrument, you can distort also the time. This is about the conspiracy of a high frequency trading. You may say to me, George, okay, are you the enemies of the high frequency traders? No. Why are you recording this video? I'm recording this video because in an orderly market, all right, majority of market participants are rewarded. Not only that, when a market is distorted, not for a day or 2 or 3 or a week, if the market is distorted for too long, the correction is unpredictable. We have seen a little bit of it in 2010 with the flash crash. I don't know whether this was a test to see whether if we pull out together, what will happen, how the market will crash. If it was a test, that's great. So they may say, oh, the test is fine. So if we keep everything in place, the market will continue to go up. But I don't believe that it was a test. One thing I always say to traders, because I trade stochastic, one of the tools that some of the high frequency traders are using is the slow stochastic, overbought sell on the 1 minute chart, oversold buy. And this strategy is crazy. They shouldn't be doing that, because if all the algorithms at one point using if suddenly most of the, because we see the number of high frequency traders increasing, and if all of them start using the same strategy and they become powerful, or they allocate more resources to the lower time frame, they can crash the market, okay, unwillingly. It's not that they are manipulating the market, but they can create a big distortion, and everybody will be saying, what's going on? Like we have seen in 2010 with the flash crash. So again here with Boeing in 2007, you can see that the stock was going up. Though technically speaking, a lot of traders, technical traders were saying that the market is due for correction. Do you remember? I knew, I was saying it, and the market was going up. But then the news came out, and look, total retracement. All the gain from 2003 all the way up to 2008 was cancelled within a year. Now, this is not, is it good for anyone? It's not good for anyone. Now, the problem was that when a market is due for a little bit of pullback, do not resist it. Let it drop a little bit. If it's due for a pullback, because the price goes up, if there's a distortion market correct itself, pull back a little bit, and then it becomes cheaper, people buy. Don't fight the shortest, don't fight the bear. They make the market cheaper. Now, it will be mad for short sellers to keep selling financial instruments that are bullish, that are fundamentally bullish. That's a distortion. No one should do that. Yes, we should highlight that. But when the short sellers are right to sell, do not stop them, because they will sell for a while and they will be buying. In fact, the same people that are shorting are also buying. We are bulls, we are bears. Now, you may say, George, look, the same people that are buying are selling, all right? They are buying, they are selling. But there are another group that are investors which are not active market participants. They are the ones that are complaining, all right? Because they think that you have to buy a stock and then forget it and hold it there forever. And sometimes when the market corrects itself, and these investors lose everything because they think that, and they keep buying sometimes when the price pulling back like this because they don't understand how the market functions. Or they give their money to some crazy people to invest for them, then they put in the wrong asset and they get into trouble. All right? So they complain that they should buy the short sellers and now bring in the high frequency traders to monitor the lower time frame, so that if the price is going to go down, everybody knows, be the first to know, and if we can stop it, we will stop it so the market can stay up. This is about the conspiracy of a high frequency trading. Ladies and gentlemen, we cannot cover every aspect of this discussion today. I will be recording another video about the conspiracy of high frequency trading. I hope you have enjoyed this one, and you have learned something from me. As a trader, you want to understand what is taking place in the market, all right, and what is the future of the market. At this rate, if the market is going up, we see a vertical move, as I demonstrate to traders at stochasticmarket.com. Click on proprietary trading, a vertical move, and the price very often will retrace back to the opposite diagonal. Diagonal move, vertical move, retracement to the opposite diagonal. These are, we can say, these are natural law, things that are happening in the market that make us humble, and no one can stop it. People are born young, and then we get old, and we can stop the old age. Stock goes up, and after a while, they go down, all right? And they go down. You see in 2008, it went down all the way here. Where is it today? It went up. The same people who sold it, the same people who came out of the market came back again and pushed it up. The market will not go down to zero. The natural progression of the market is up. The market always wants to go up. That's natural. Why the market goes down? Sometimes people take profit. If you have one big investor that holds, for instance, 60% of a company, and probably he knows something that you don't know, he's the biggest investor, and he decided to pull his money out of that stock, the stock will crash. But if it's not a big stock, who cares? No one cares. But if it's a big stock, then everybody will be crying. All right? Hope you have learned something from the video also, and we put it to use to make excellent trading decision. Until the next time, enjoy yourself and be very happy. We are the TSTW 24 traders. This is about the conspiracy of high frequency trading. Speak to you soon.